Right now, it feels like the market is scared. And honestly, that fear makes sense. If you've been watching the headlines, it looks like everything is hitting at once. Geopolitics, tariffs, bond market stress, tech selling off, gold ripping higher. On the surface, this feels like the start of something ugly. But here's the thing most people miss. Fear itself doesn't automatically mean the market is broken. A lot of the time, fear is just uncertainty getting priced in all at once. Let's start with what triggered this move. The immediate catalyst isn't a recession or collapsing earnings. It's political rhetoric. The market is reacting to aggressive language around tariffs and geopolitical pressure, especially involving US relations with Europe. The key word there is rhetoric. Nothing structural has actually changed yet. No sweeping tariffs are in place. No trade flows have shut down. But markets hate uncertainty more than bad news, so they sold first and asked questions later. Before we go any further, if this kind of macro breakdown helps you think more clearly about markets instead of reacting emotionally to headlines, take a second to like the video and subscribe. It helps the channel a lot, and it lets me know you want more calm, data-driven market analysis like this. And when markets sell first like this, they often overshoot. Another thing happening right now is positioning. Before this sell-off, investors were extremely comfortable. Volatility was low, hedges were light, and risk exposure was high. That's a fragile setup. When a shock hits, even a headline-driven one, everyone rushes to protect themselves at the same time. That's exactly what we're seeing now. Volatility spikes, hedging comes back, systematic funds reduce exposure. Paradoxically, that process is healthy. It clears excess risk out of the system. Markets tend to crash when no one is prepared. Right now, everyone is prepared. You can also see this fear spilling into bonds. Global bond markets are under stress, especially with rising yields in places that are usually stable. That's unsettling, but it also creates pressure on central banks. Policymakers don't like disorderly bond markets. Rising long-term yields tighten financial conditions without them doing anything. Historically, when that happens, central banks lean more cautious, not more aggressive. Equity markets don't need rate cuts to rally. They just need the tightening pressure to stop accelerating. Another important point is the economy itself. Strip away the headlines and look at the data. We're not seeing recession-level signals yet. Employment is still holding up. Corporate earnings outside of the most cyclical areas are stable. Consumers aren't collapsing. This looks far more like a slowdown than an economic failure. Markets often struggle during slowdowns, but slowdowns don't automatically turn into deep bear markets unless credit breaks or earnings implode. Neither of those is happening right now. A lot of attention is also on tech and AI selling off. That's being framed as a bubble popping, but the data doesn't support that narrative yet. What we're seeing looks more like valuation compression and rotation. Money isn't leaving the market entirely. It's moving from crowded, expensive growth into areas with stronger cash flows and real assets. Leadership changes don't end bull markets. They extend them. Even gold hitting highs isn't necessarily a bearish signal for stocks. Gold tends to rally during periods of policy uncertainty, not necessarily during economic collapse. Historically, equities often recover after gold peaks because uncertainty fades faster than fundamentals deteriorate. So when you put this all together, what's the market actually pricing? It's pricing uncertainty, not failure. Uncertainty can disappear quickly. Failure takes time and leaves clear footprints in credit spreads, defaults, and earnings. Those footprints aren't here yet. That doesn't mean risk is gone. The biggest thing that would break the bullish case is a real trade war combined with rising inflation. That combination would box in policymakers and pressure margins. But short of that, the current setup looks more like a reset than a breakdown. The irony is that the market often becomes most bullish right when people feel the worst, not because the fear is justified, but because the selling power has already been used. Once everyone is hedged, defensive, and cautious, it doesn't take much good news or even less bad news to stabilize prices. So yes, there are real reasons the market is nervous. But there are also real reasons to believe this fear could be temporary, not terminal. The difference between those two outcomes won't be decided by headlines. It'll be decided by whether uncertainty turns into actual economic damage. And so far it hasn't. If you want more videos like this where we slow things down, cut through the noise, and focus on what actually matters for long-term investors, make sure you're subscribed. And let me know in the comments what part of the market you want to break down next.